ในช่วงของ World Update วันนี้นะคะจะพาคุณผู้ชมค่ะไปพูดคุยกันกับผู้จัดการกองทุนต่างประเทศอย่าง Invesco นะคะซึ่งก็เป็นผู้บริหารกองทุนต่างประเทศที่บริษัทหลักทรัพย์จัดการกองทุนรวมกรุงไทยนั้นได้คัดสรรมาดูกันนะคะว่าท่ามกลางภาวะการลงทุนที่ผันผวนแบบนี้ในมุมมองของฟันต่างประเทศเนี่ยจะมีมุมมองอย่างไรต่อการลงทุนในตลาดหุ้นยุโรปเดี๋ยวเราไปรับชมกันได้เลยค่ะ
We have been seeing a lot of the market going up lately for the past few years, and now there's a big correction due to several factors. Do you think that this will be like the end of the bull market soon?
Well, we think this economic cycle has progressed really well, albeit it's been very shallow. And when you, for instance, look at the U.S. Economy, it's true that it's been going on for about I want to say 120 months, which makes it the second longest recovery in history.
10 years, right?
Almost 10 years. And we think when you look at going forward, there's at least another 2-3 years in the US cycle left. And that's because of the tax cuts that Trump has announced. And we think economic growth is still very good in the US. Now, when it comes to Europe, the start of the recovery was a lot later than in the US. And we think that when you look at European growth, at the moment, it's really driven by a combination of government spending and consumer spending. Now, those have been traditionally very stable components of the economic growth. And that means that when you look at European growth going forward, we expect it to continue at its sort of pace of sort of 2–2.5%. So we expect global growth to remain good and Europe to remain solid. And that's good enough for European equities, given they are cheap, they're under-owned, and we are seeing a lot of earnings recovery in Europe, driven mainly by margins rather than very strong revenue growth.
Okay, so that probably is what people thought before the trade war issue and also the rising interest rate of Fed coming into the picture, right? I mean, that worried investors quite a lot. What do you think about that?
I think you're right in pointing out that the interest rate regime has changed. And we think mid-2016, the interest rate regime in the world changed from a long period of lower rates, and you know this thought of lower for longer. We have now moved into a higher rate scenario. Now that's really important for equity investors because it changes the type of company you want to own, and we think that everything with stable growth, with predictable dividend yields, we think that those parts of the market are overvalued. What we like is cyclical growth, and we like very high secular growth. We think cyclical growth is very cheap, especially in Europe. And again, this is driven by extremely low margin businesses at the moment, where we see a lot of potential for higher margins as economic growth kicks in. And secondly, we think that in Europe we find a lot of businesses that have very interesting disruptive technologies, which mean they can grow their top line very fast. Now, in Europe, those businesses are still very cheap, whereas in the rest of the world, those businesses are already very expensive. So, you know, the two types of businesses in a higher interest rate environment that we like is cyclical growth and it's secular growth. We're still pretty worried about sort of stable growth type businesses. We see is in places like industrials, technology, energy. So some of the businesses we've recently been buying are oil services companies. And these are amongst the highest quality businesses you can find in Europe. And we think that after a long period of very low investment in things like deep sea oil exploration, we are now starting to see a recovery there. And those businesses, we think, have a lot of margin potential. And secondly, we think the outlook for growth over the next few years is very good for them.
Okay. What do you think about the trade war issue?
Well, in terms of the trade war, it's really important to peel the onion a little bit back. When you look at what Trump is trying to achieve, it is essentially two main issues. One is the intellectual theft that China has been doing to Western companies when it comes to technology. And you got to think, God, the rest of the world, Japan, Europe, Korea, we all agree with this. And the second point is the dumping of commodities in Western markets, whether it's steel or other products. And when you look at what is actually happening, you can see that China has closed down a lot of steel production already. And they've done this under the environmental banner. But the reality is, and this is from watching European and world politics for a long time, never listen to what the politicians say, watch what they do. And when I look at what's going on with intellectual property, or when I look at what's happening with commodity dumping, I get very encouraged to see what's going on with China. Now, as far as the trade relations between the US and Europe, so Mr. Trump wants to put tariffs on German cars. Now, let's think about this for a second. Why do Americans buy Mercedes and BMWs? Because they're cheap? No, they're way more expensive than a Chevrolet or a GM car. They buy them for quality, performance, and status. So if you put a tariff on those, will that deter people from buying a Mercedes? I'm not sure. So I think what we, again, don't listen to what the politicians say. I think what Trump is doing is essentially showing China that he's having a go at everybody. Canada, Mexico, the EU. I think the reality is this is about China and those two issues that we discussed. I think trade relations between the EU and the US are actually fine. So we're not so worried about this. We need to sit through this over the summer. And I think once we get more clarity, we can go back to the fundamentals. And the fundamentals of economic growth are good. The fundamentals of margin recovery in Europe are good. The valuations in Europe are very attractive. And we think Europe is under-owned by pretty much the global investment community. So we see a big opportunity for Europe in the second half of the year to perform really well.
Can you give us a suggestion?
Well, what we like in Europe at the moment, if I look at continental Europe, we tend to think about three regions. We like the core of Europe, so that's Germany and France. We like the periphery, which is Italy, Spain, and Portugal. Where we see fewer opportunities is places like Switzerland and Scandinavia. We think those markets are more expensive. When I look at the big sectors, we like cyclicals, we like financials, and we are very underweight defensives. And the reason for that is that this predictable growth in Europe is very expensive, given how traumatic European investors still are. And you know, in a rising rate environment, which we think we are, European staples, utilities, and telco stocks will underperform. So, you know, the big opportunities for us are in the cyclical areas in the market and in financials, and then predominantly in the core of Europe, places like France, places like Spain and Italy.
Okay, that's it. Then thank you very much, Eric, for your time.
Thank you.